An example of a hard asset would be investing in something like real estate, because when you invest in real estate, you can see, feel, and touch the bricks. You can see, feel, and touch the property. When you invest in a stock of Amazon, you don't actually own any physical thing. You buy a piece of paper that says you own some of the Amazon company, but if you walked into the Amazon factory, they wouldn't know who you are. When you invest in a rental property, well, now you are the one that's in control. It is a hard asset and you see, feel, and touch the land that you own. Now notice that I said real estate investment rental property. When I talk about investing in a hard asset, I'm not talking about you buying the home that you live in. That home that you live in, I consider a liability. I consider an expense, not an investment. I know this goes against most traditional financial advice that you get, but for me, the house that I live in is an expense. It's not putting money in my pocket. Sure, maybe it goes up in value, but then I have to actually sell the house to realize that money, or I have to take on more debt, but that's not actual money, that's debt. So when we talk about real estate investments for the purpose of this video, I'm talking about going out and buying a rental property, because when you have a rental property, here's how it works. Maybe you go out and you find this house for sale for, we'll call it $200,000. Now the goal is you're not going to buy this house to live in yourself. You want to rent this house to somebody else. So you find a nice family who wants to live in this house, and because you built this amazing house for them, they are excited to live in this property, and maybe if you do it properly, they will pay you, let's call it $2,100 a month to live in your property. This is the money that's going to you as the landlord, as the investor for owning this property. Now, the first thing you're going to say, I already know, is, Jaspreet, where in the world are you going to find a property for $200,000 that you can rent out for $2,100 a month? Well, if you're living in Miami, if you're living in California, if you're living in New York, yeah, it's not going to be possible. But there are many states and many cities around the country where you can find these types of deals. In fact, my office is in downtown Detroit. In Southeast Michigan, which is a beautiful area, by the way, you can find these types of deals all day and night long. So you find a property for $200,000 that you're now going to rent out for $2,100 a month. It's a nice property. This family is happy that they get to live in your property because you're giving them the value of a home. They pay you rent, and now you got to pay for the expenses. What are these expenses? Well, you got to pay property taxes. You got to pay for the property insurance. You got to pay for the maintenance, because when the toilet breaks, you got to pay for it now. Then you got to pay for the management, because I don't want you to be the one that's getting the phone calls when the toilet breaks. I don't want you to be the one that gets the calls when something's wrong with the plumbing. I want your property manager to deal with all the headache. I want you to be the investor and just make sure that you're getting paid. And then you got to pay for any vacancy costs as well, because sometimes these people are going to move out and they're going to find a different house to live in for themselves, and you're not going to be getting rent. And so you want to make sure you have the cash to cover that time as well. So now let's run through some numbers. $2,100 a month in rent times 12 months a year is $25,200 a year in gross income. Now you got to subtract your expenses. That's property taxes, insurance, maintenance, management fees, and your vacancy costs. So let's assume that that costs you around $11,000 a year to maintain this property. And I'm going to assume for the purposes of this video that you brought this property cash without a debt, because we're going to just keep this very simple for the purpose of this example. That means your profit at the end of the year after paying for all of your expenses is about $14,200 a year. But now let's do a little bit more math to see if this is actually a good investment or a bad investment for you. You're making $14,200 a year. You put in $200,000. So if you take $14,200 and you divide this by $200,000, what this tells you is you're making about 7.1% a year in cash in return on your investment. You put in $200,000 of your own cash, you're making $14,200 a year, which means you're getting a 7.1% cash on cash return on your money. Is that good? Is that bad? This is going to depend on you, where you're investing, and what types of returns you're looking for. For me, this is a good return. I'm looking for a minimum of a 7% cash on cash return on my money. I want to invest my money in an area which I believe is growing, where I believe rental values are going to rise. I don't really care about property appreciation. I don't like trying to guess that maybe this property is going to be worth $300,000 in 3 years. That's not the game that I'm playing. When I invest in real estate, this is what I'm looking for. This is what I'm looking for. I want to see how much money do I have to invest today and how much cash flow am I going to get each year for my investment. That's the game that I'm playing as a real estate investor. Now you got to decide what's right for you, because if you're investing in New York or Miami or Los Angeles, you're not going to see the same 7 or 8% returns. Generally, in today's market, it's going to be a whole lot lower. And you got to find what's right for you and what types of investments you're going to be looking for. But this is a hard investment, because now you own the property, you own the bricks, you own the land, you own the windows. It's something you can see, feel, and touch, and it's something you can operate as well. Now you might say, well, Jaspreet, I don't got $200,000. I'm not saying you have to start with $200,000. There's many different ways that you can get started. If you don't want to go out and buy this whole property yourself, obviously you can use debt. Obviously you can go out and raise money from other investors. Maybe you have rich family members. Maybe you have some rich friends. You can raise money from them if they don't have the time, but they have the money, and you got the time, but no money. Now you are a good match for each other. Or you can look for other deals to invest your cash into as well. If you go to any real estate investor conference in your area, they happen all throughout the country, you can look for people that are looking for money. And there's always people looking for money. There's always developers, there's always investors, there are always people that are looking for funds to go out and build or manage the next deal. Well, you can give them some money and then you get some ownership in the project. So now you just got to figure out what's the game that you want to play. Do you want to just invest your money to get exposure to the real estate, or do you want to actually own the real estate yourself? Now that we went over paper assets like stocks and hard assets like real estate, let's talk about protectionary assets. An example of this would be investing in something like physical gold, because when you're investing in gold, you're not hoping that this gold goes out and creates more value like you would a stock. Because when you invest in Amazon, you're hoping Amazon's going to create a whole new product, make bigger profits, and grow their valuation because it's a more valuable company. When you invest in gold, that gold just sits there and looks back at you. It doesn't really do anything. Now sure, there are some practical uses for gold in the world, but that gold that you have sitting in a vault, if you're investing in gold, or sitting in your drawer, sitting in your basement, it's not doing anything. It's just sitting there. And so the goal for the gold is that it is a protectionary asset against a worst case scenario situation. The way that I do it, again, I'm not telling you what to invest in. I'm not telling you what to do. I'm just telling you what I do. When I invest in physical gold, I buy a little bit of gold every single month. It makes up a small piece of my total portfolio, about 2% of my total portfolio. But when I invest in gold, I don't consider it an investment per se. I look at it as a way of saving hard money, kind of like hard dollars, hard money, because my theory is if I were to take $10,000 worth of cash today and $10,000 worth of physical gold today, and I buried both of those two things in my backyard today, and then 10 years from now, I go to dig up the cash and I go to dig up the gold, my theory is that the gold would have more buying power than the cash. So I look at it as a way to save hard money, and we know that gold has been a currency since the beginning of time, essentially, and so it has been a universal money around the world, and so for me, it is like that type of insurance, a doomsday insurance and a way to save hard money. It's not something that I really monitor the price of. I don't really care what's going on with the prices of gold. I know gold became very popular post-pandemic, after the worries of inflation, after the worries of people concerned about the dollar. It started to become a lot more popular. For me, it didn't really change anything for me. It was just continue buying a little bit of gold. It's not a lot, buy a little bit of it, and just keep letting it do its thing, and it's just a way to save some hard money as protection. That's why I call it a protectionary asset more than anything else. It's not a big piece of my portfolio. It's a very small, tiny piece of my portfolio, just in case, worst case scenario. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.